Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by just one global market specialist, Joann Spadigam. Okay, with the US out for Thanksgiving holiday, and given that we ran through our kind of year ahead key themes in last week's episode, Joann and I have been on the road all week for the last week, kind of marketing those views to a whole host of our clients that are London based. So I thought before we kind of got into this week's events and what we're looking forward to next week, etc., it would be worth just running through kind of the key takeaways from those meetings that we've had so far, and I guess marketing to a certain extent our year ahead views and seeing how they kind of fit with the consensus. The biggest takeaway for me from the meetings that we've had so far is that there's a real sense of polarization, I suppose, in views when it comes to central banks. You know, there's clearly, as we can see from market pricing, a kind of growing majority that think that, you know, this kind of table mountain, restrictive for longer narrative is going to be challenged quite early or in quite a big way in 2024. But there's still a large minority that, you know, sit on the more hawkish side and think that actually current market pricing, and although it's very volatile at the moment, we're moving around a lot, but current market pricing of, you know, a somewhat easing of monetary policy from the Fed and the ECB and the BOE next year is perhaps overdone. Most of the concern from those that sat on the more hawkish side of the fence, I think, centered on the wage setting process in Q1 in both Europe, that's in Germany in particular, but also in the UK. And I think that that's probably a concern that we share, or at least we understand that that's where the risks perhaps are to our view that banks will be cutting, you know, at some point next year. That was really where there was broad consensus that the kind of wage setting process early next year could be a trigger for challenging this table mountain narrative to the upside. Even amongst those that were more dovish, you know, those that thought that central bankers were going to have to kind of throw the towel in on this restrictive for longer policy earlier than they were currently signalling, I think our most off consensus view was that our view that the ECB would be A, the first to cut of the kind of G3 central banks, but B, also they could cut as soon as March, which, you know, as you heard last week, is one of our key calls for the year ahead. So, Joann, perhaps this is a good time to bring you in, because I think there were three main pushbacks to that ECB view, and perhaps I'll just run through them kind of each in turn, and you can kind of give me your thoughts around each one. So the first pushback was really that the ECB wouldn't be the first to cut because they generally tend to lag the Fed. And so, you know, if we don't have the Fed cutting until May, for example, in our central scenario, it would be very unlikely for the ECB to cut as soon as March. What do you say to that?
Yes, I think on that point, I don't think it's been, so it's not necessarily unprecedented that the ECB has sort of cut ahead of the Fed. I do think what matters more in this context really is that the US data continues to kind of soften and does continue to indicate that the Fed could indeed be cutting next year. So I think what really matters is that the trend for the US tends to continue, and markets obviously are pricing in around 30 basis points in cuts by around mid next year in the US, but also in the euro area. So I think that kind of general idea that the Fed will cut is probably more important than necessarily the timing of the ECB before the Fed. The economic data in Europe obviously is weaker in terms of the growth outlook, which is weakened. Inflation is coming down as well. So I think with the growth picture being a bit weaker in Europe, it does make sense for the ECB to go first. And I think it's probably not important to not overstate the lag between the ECB and the Fed. Our kind of base case is that the ECB could shift in March 24. And like you said, the kind of US call is early Q2. So I mean, the lag is around 1 or 2 months. So I wouldn't overstate that lag. And really, I think that the economic data in the US will be important to watch more than kind of whether the ECB can go earlier than the Fed.
Yeah, and I think that's the key point as well, is that it's not always the case that the ECB wait for the Fed before they can cut. So the second pushback that we got frequently was that the ECB wouldn't want to cut rates before they've made a decision on PEP, so their pandemic emergency purchase program. There's some speculation, growing speculation, that they could accelerate the rundown of PEP as part of their overall balance sheet shrink, but that they wouldn't want to cut rates ahead of making a decision on whether to accelerate that or not. And I suppose the kind of operational details behind the acceleration. What do you make of that?
I think a few points on kind of PEP and early rate cuts. I think the first really being that across all of our G3 central banks, we do expect that QT continues even with the rate cutting cycle. I think central banks do see these two things as separate tools, and that kind of rate cuts can actually go hand in hand with QT. I think on rate cuts in Europe and with QT in Europe, I think the way I'm thinking about this really is a normalization in the balance sheet, both in terms of rate cuts as well as in terms of the balance sheet unwind component. We've said this many times before that if you do leave rates where they are right now, whilst inflation is coming down, that would be an implicit tightening in policy into next year. So really rate cuts are a normalization of policy. And in line with that, the balance sheet unwind component as well. So actually getting rid of PEP would also be a normalization of policy in that regard. So again, I think both this kind of rate cut story and PEP really do sit in line with the normalization of policy. The operational framework is interesting, of course. I mean, I don't necessarily again see how that this ties in with the rate cut scenario, because I mean the balance sheet. The future of the balance sheet is a much more longer-term question to kind of consider, whilst rate cuts at this point really is being prompted by the deterioration in the macroeconomic background, which is a much more imminent issue versus the balance sheet, which I think will take quite a long time to get to levels where we have to worry about the demand versus supply of reserves. I think the last point to really make on PEP and rate cuts is that you could really see a scenario where the kind of rate cuts in PEP act as a bargaining tool between the hawks and the doves. I do think, of course, the hawks in the committee are quite keen to unwind PEP. Just today, we got comments from a ECB hawk noting that PEP should be unwound. There's no reason to keep PEP on the balance sheet. So I do think really this could be a negotiation tool where the doves kind of talk about normalizing the front end, normalizing the rate side of things, and bringing down rates, whilst the hawks kind of talk about balance sheet unwind. I think what's important or interesting to note as well from our meetings is that whilst we did get pushback on potentially timing, we didn't really get too much pushback on the idea that PEP could be brought forward to kind of mid-24, which is our base case, or that there might actually be a gradual unwind in PEP versus this kind of full roll-off kind of idea. So, I mean, I think those kind of 2 points were also interesting to note.
Yeah, that was definitely perhaps a more consensual view than the ECB rate cut view. And then the final pushback, which we receive frequently, and I sort of touched on it in the points that I was making about where we see the skew of risks and what's driving those risks, was just around the wage setting process. So lots of people thought that it would perhaps be too early for the ECB to cut because they wouldn't have kind of full visibility over how those wage negotiations had gone in Q1 as early as March, and therefore, whilst not necessarily pushing back on the idea that the ECB could be the first to go and they could go early next year, perhaps the end of Q1 was still a little bit too early because of this early year wage setting round. What do you make of that?
So the data on the wage setting round will only officially be out in May, I think. But I do think that earlier in the year, we will get an indication of where these wage negotiations are going. And that is what they could use to potentially cut rates as soon as March. I think a couple of things going into the negotiations as well. We obviously had a fairly weak economic backdrop for Q3 and Q4. So we do really think that this wage, kind of the peak in wage inflation, is past us at this point. With inflation coming down and with growth kind of slowing, this bargaining power that the wage negotiators have is obviously a bit weaker into Q1 next year than it was into this year. So I do think the peak is kind of past, and the ECB will get a indication of where these wage negotiations are going by the March period where we expect the rate cut to come through.
Okay, great. Thank you. And then just to finish up, I suppose, on the BOE for completeness, I don't think that there was a huge amount of pushback, although it's important to note that this definitely wasn't a unanimously held view, that the BOE could be the last to hike out of the G3, which is our base case. For longer dated rates, I think I've spoken about it on this pod plenty of times, but to me, it felt like there was an element of complacency around how easily supply might be digested next year. It didn't feel like there was all that much concern about supply indigestion. I think quite a common view was that a turn in rates or a peak in the cycle and a turn in the data would be sufficient to bring back demand for duration globally and demand for UK assets as well. And that the additional issuance from governments and the potential increase in QT that we're seeing from the BOE that we might be seeing from the ECB as well would be relatively well absorbed. I think maybe some of this pushback, particularly on the UK side, came alongside sort of growing speculation that actually the Bank of England may look to either slow or pause QT, or at least skew the way in which they sell the bonds in order to limit the losses that they're locking in on QT. That's an additional drag on public finances in the UK, or that they might be looking to implement some kind of policy, whether that be a kind of tiered reserve policy or something else that limits the kind of cost of carry that they're paying on their portfolio of gilts. Neither of these are our base case, and perhaps that's why we sit at the slightly more bearish end when it comes to how this kind of supply demand imbalance might impact yields next year. But I did think it was an interesting point to note. Despite that, though, I think market consensus was very much still for steepness globally across the US, the UK, and Europe, although perhaps consensus differed a little bit, or views differed a little bit in terms of timing of putting those steepness on, and also whereabouts on the curve it was better to hold those steepness.
So I guess just talking about supply a bit more, let's talk about the autumn statement, Imogen. What are your thoughts on that?
Yeah, that was the big event really in the UK this week. Although in the end, perhaps nearly everything that was announced had been leaked really in the press beforehand, so it perhaps wasn't as exciting as it could have been. I mean, the message around the autumn statement very quickly changed from months of kind of pitching this idea of fiscal responsibility, and then perhaps last week's inflation data, given that Rishi Sunak had sort of achieved his aim of halving inflation from double digits earlier in the year, that plus the undershoots that we've already seen so far in the public borrowing data this year, left the government with a little bit of leeway for a little bit more fiscal expansion than they were expecting. Without going through the kind of measures in detail and just sticking to the market conclusions here, ultimately the revisions to this year's funding needs were not that far from our base case expectations. We had revisions of 15 billion, a downward revision of 15 billion, and the outcome was a downward revision of 10.5 billion. So not that far from expectations, but there were two elements that made this slightly more bearish for gilts than we had been expecting. In the near term, the first is that all of that downward revision, or nearly all of that downward revision, came via bills rather than a reduction in gilt supply next year as we had been expecting. And that reduction in the overall remit came alongside a revision to the buckets because they reduced the unallocated portion, and we were expecting a not sizable, but a shift towards the shorts and mediums buckets and away from the longs and linkers. And in the end, we didn't really get that. We kind of got the reallocation or redistribution of that unallocated bucket was broadly even across the curve. And so, against our expectations of a slightly shorter skew, that kind of added a double whammy of bearish pressures, perhaps at the longer end of the curve. For me, though, for markets, focusing on those very near-term takeaways, almost misses the bigger picture. And that was that yesterday we got revisions up to public financing requirements from next year every year through the forecasting period from an already high base. And so, it really kind of hammered the point home that we're talking about a multi-year regime shift in the issuance outlook. And I'm still worried about the market's ability to absorb all of this issuance. And, in some ways, for me, this week has cemented the case for gilt underperformance next year. Listeners who listened to the year ahead episode last week will know that that was one of my key calls for the UK next year, is that we should see gilt underperformance on a cross-market basis. And I think yesterday's autumn statement really hammered that home. We're talking about a huge increase in supply over the next couple of years relative to the size of the market and relative to the supply numbers that we've seen over the last couple of years. We're talking about QT that's continuing and locking in huge losses, which adds ultimately to public funding needs. In yesterday's autumn statement, the OBR revised up its cost of QT estimates back to end 2026 by 80%. That's a very sizable revision. And as we know, QT is happening at a faster pace, and they're actively selling in bonds and locking in bigger losses than other central banks. And all of this comes against, still a lack of demand for gilts in general, but also measures within that autumn statement that were designed to direct some of the demand that you might otherwise have from pension funds at the longer end of the curve into other assets, kind of UK growth assets. And at the same time, I suppose, relative to a kind of previous baseline, the fact that we got slightly more fiscal expansion than we were expecting, and then the BOE had baked into its previous projections, you maybe at the margin have a little bit more of demand support going forwards. And that kind of also reinforces our view that the BOE will or could well be the last to cut. I keep saying hike when I mean cut. Could well be the last to cut in the easing cycle next year, and they will be the ones that kind of hold this restrictive for longer narrative than other central banks, which too should drive some, relative underperformance of gilt yields. And I think that's what we've seen in the last couple of days. You had this bearish autumn statement, and then you had the very marginal but still upside surprise on PMIs, and markets are suddenly questioning this kind of dovish shift in sentiment that we've had over the last couple of weeks. And regular listeners and readers of our notes will know that I thought that dovish shift in sentiment had gone a little bit too far, and that a reversal was overdue, let's say. But we've also had kind of supply updates from European countries as well this week, not just about the UK. So to wrap this up, Joann, do you want to just update us on what's going on in Europe?
We interestingly had a cut in Italian issuance for the rest of the year. That's around 14 billion, we estimate, lower in terms of their kind of market funding. I think it really stems from two real things. So firstly, there was a lot of issues with the EU over this year and uncertainty about whether they would get this funding. So that probably meant that the Italians did do some pre-funding in anticipation of the fact that they may not get EU funding. We've also had a fairly big year of retail issuance in Italy, where the BTP Valore has had a very good take-up by the retail sector, and that's also likely meant that they've had a bit more cash coming from that than they anticipated, which has led to this kind of cut in Italian supply. The other kind of interesting thing for Italy this week, though, has been that Moody's has updated their outlook for Italy, moving them from a negative kind of outlook to stable. And I think that was a little bit unanticipated by most market participants, given that the deficit picture for next year was also revised upwards more recently. But I think potentially that's in line with the idea that both S&P and Fitch actually have a higher rating for Italy and a stable outlook that was confirmed off late. So maybe that revision is not too out there. I do think for BTPs, we've obviously seen a couple of positive stories from this week, but I do think that the PEP story remains quite important for Italy going forward. We've obviously had a bit more of a, I suppose, quiet period where the ECB has been unwilling to talk about PEP very much. But I do think this story will gain traction once again into Q1 and will again probably lead to a bit more of a widening in BTP bond spreads. the spread does seem to have been very reactive and very directional at the moment. So not really been driven over the last kind of month by anything Italian specific, even though this week, of course, we've had some positive news. So I do think that any big reversal of the rally we've seen could actually mean that BTP Bund spreads widen once again. So we're a bit cautious about lowering our BTP Bund target at this point, but we are, I think, a little bit bearish on that at 210 bips at the moment. I suppose in terms of other supply kind of picture thoughts we've had for this week, we've also had lots of talk about German fiscal policy. I think it's a bit uncertain at this point what that means for 2024 Bund supply. It likely means a lower Bund supply for next year, if anything. But it does seem like the Germans have removed their debt rate for this year, and there's likely to be a supplementary budget coming in at some point next week. So they are leaving us hanging for now, but I do think in terms of 2024 supply of Bunds, it does seem to be either the same kind of supply coming in as we've kind of penciled in, or revision downwards at this point. It does seem like the Germans are unwilling to increase fiscal spending for 2024, given they haven't revised the debt rate for next year just yet. That's it for me, I think, on the supply side.
Okay, great. Let's wrap it up there then. And we'll be back next week in full force with a US contingent as well, hopefully in the form of Jan. And we will update on all of our thoughts when we get there. Right. Thank you, Joann, for joining me. Thank you to our listeners for tuning in. Just a reminder, if you like today's episode, please don't forget to click the like button and hit subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.